Fed Chair Powell brings back memories of 2022. Musk's partnership with Ambani and Mittal, a game changer for Indian telecom, and why Google's parent simply can't catch a break. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode of the Stock Doctor podcast. We're still maintaining our Tuesday schedule, just a little later than usual. Had some morning chores to run, wrapped it up, and that's why the slight delay from my usual time of around anywhere between 10 and 12. Hopefully, we'll be back back to the schedule. But I can see that you guys like the Tuesday release, so I'm going to stick to that particular schedule. Right. Lots to talk about, guys, as usual. The Federal Reserve played a big role in helping the S&P 500's weekly advance. The week that went by firmly belonged to the Fed. The central bank on Wednesday held interest rates steady as widely expected, so no surprises there. And even though it updated, it updated its GDP projections to the downside and higher inflation expectations. Basically, overall, and as you'll hear about it in a bit, overall it was okay. It was kind of as expected. No unnecessary surprises. Markets like when there is no unnecessary surprises, and so finally the S&P 500 and the Dow and the tech-heavy Nasdaq all they broke their 4-week losing streak. Now, what was very what really drove the markets higher was not the decision per se, but also the comments at the post decision press conference, and I'll get to that in a little bit. Now, before I get into the details, let me give you a quick recap of the markets as usual. Like I said, 4-week losing streak has been broken. It was a winning week. Dow climbed 1.2%, S&P 500 jumped 0.5%, and the tech-heavy Nasdaq jumped 0.2%. So not major, but at least the whole point was it was a winning week. So without further ado, let me welcome you to the first segment, the Doctor's Weekly Snapshot, and take you through all the major developments in the US markets last week. I mean, listen. One thing, of course, the week belonged to the Fed. So I'm going to talk a lot about the Fed. I'm going to talk a lot about Fed Chair Jerome Powell. Now, but here's the deal. He did a lot for the market. Okay, he did a lot for the markets. At one stage were definitely looking to go down. So he did a lot of positive things for the markets, but you still got to feel sorry for the guy. Okay, not just for the guy, for the entire Fed officials. They were on the cusp. The Fed was on the cusp of achieving something that no US central bank official had achieved for a long, long time, and that is take the United States of America to the promised land called soft landing. In 2022, right, in 2022, when basically the interest rates was skyrocketing, people were expecting the only way to bring interest rates down would be a recession. Soft landing is a promised land, but that is a fictional land. Forget about it. We're not reaching there. The economy will break. At some point, at one point, there were government officials blaming the Fed for breaking the economy, or rather for getting close to breaking the economy. And yet somehow, by miracle or not, by either it's a miracle or you either got lucky or it's pure genius, Fed officials were on the cusp of achieving the soft landing scenario, and the soft landing scenario was expected to by the end of the year, right? I mean, 2 or 3 more rate cuts, and we would have avoided everything. Today, though, there is a strong chance, and here's why you really got to feel sorry for the guy, not just Chair Powell, but also the entire Fed team, the Fed officials. There is a strong chance that they could actually fumble the ball at the 1-yard line. American football reference for you. Basically, you could use any other athletic. You could basically say a 100-meter sprint and you slip right at the 1 meter mark. Just about as you were about to finish, you slip and fall, there's a very high chance that any of these sporting analogies could very well happen. The problem is, normally when you have 1-yard line, or when you slip, it's the athlete's fault, right? It's the athlete's fault, or in American football, it's the quarterback's fault or the receiver's fault or whatever it is. But here in this case, they are going to fumble, or there is a high chance that they could fumble the soft landing promise, and it's not even their fault. I mean, I don't think they could have foreseen I mean, they would be Nostradamus, not just genius. They would be Nostradamus if they could have foreseen the kind of tariff onslaught that President Trump has now planned to unleash on the rest of the world. Sure, there was a Trump 1.0 playbook that the Fed officials could have relied upon, but Trump 2.0 is so different and so vicious compared to the first edition that I don't think studying the Trump 1.0 playbook would have made any difference. And I'm sure they did. It's just that it's a different version of the Trump administration that we're receiving right now. It's a different version of the Trump administration that we're receiving when we talk about tariffs. So even if you have the answers from Trump 1.0, the questions are totally different. Either way, whether they've gone through it or not, Trump 1.0 playbook would have made no difference. But last week's Fed meeting did show that Fed officials are expecting the tariffs to have an inflationary impact, and they don't think, rightfully so in my opinion, that President Trump is bluffing. The Federal Reserve maintained its benchmark federal funds rate at approximately 4.3% during its policy meeting. The decision reflects a very cautious approach as the Fed assesses the impact of recent policy changes, including tariffs, on the economic outlook. Again, they're doing the right things. The Fed is doing the right things. It's just that not their fault that if we do fumble, boy, oh boy, are we going to get a massive sell-off in the markets. But if we do fumble, I don't think anyone can blame the Fed for this one. New projections indicate that 11 out of 19 policymakers expect at least 2 rate cuts this year, down from 15 in December. I mean, even though it's down from 15 to 11, still not bad. It still makes complete sense to me that 2 rate cuts was what the markets and investors and economists predicted. I think as things stand, we're getting that, and it suggests a more conservative. I mean, while it suggests a more conservative stance compared to previous expectation, a drop from 15 to 11 doesn't really. I mean, it doesn't really tilt the table to that much of tilt the needle to that much of conservatism. Taking the tariff impact into mind, the Fed forecasts inflation to rise to 2.7% this year, up from 2.5% in its January expectations, primarily due to tariffs. However, officials do expect inflation to slow down in 2026 and 2027. The projected GDP growth for 2025 is 1.7%, and that's a decrease from the 2.1% that the Fed forecast in December. Fed officials also announced that they plan to slow the reduction of its $6.8 trillion asset portfolio by allowing $5 billion in Treasury securities to mature monthly without reinvestment starting in April. This decision aims to avoid market dislocations, and I still think it's a very, very good thing to do because you don't want to suck liquidity out of the system. That dramatically, especially given the macro uncertainty. So they have kind of slowed that down. Again, they're doing the right things there. However, they believe that if inflation is temporary, it might not necessitate immediate action. If you take all of this into account, all the factors, different factors into account, what you will understand is that the Federal Reserve is adopting a very cautious stance due to economic uncertainty, particularly related to tariffs and their potential impact on inflation and growth. You got to feel for this Fed. Yeah. Now, I'm going to give you more evidence as to why you got to really feel sorry for Jerome Powell and co. On one hand, they have to handle the economic chaos thanks to the impact from the potential trade war, as well as the potential negative impact on the labor market stemming from falling immigration and reduced federal contracts, which may affect labor supply and demand, subsequently impacting inflation. On the other hand, so on one hand, you have the economic chaos here, driven by labor market, potential weakening of labor market, as well as the potential impact of the inflationary impact from the trade war. On the other hand, they have to deal with the political challenges that have a more direct impact on the central bank. These include consistent attacks from President Trump and a recent executive order, which gives the current administration more oversight of the Fed's regulatory agenda. Though this new executive order exempts monetary policy, this particular order has indeed raised questions about potential challenges to the Fed's independence. Some Fed officials have shifted their stance from dovish to hawkish, so from more positive on the economy to negative on the economy. And this reflects changing economic conditions and differing views on how to address inflation and growth. And Chair Powell himself has urged his fellow Fed officials to maintain a cautious communication strategy to avoid provoking the new administration. In what is his final year as Fed chair, his term as Fed chair expires next year, and I don't think he's coming back. President Trump, I don't think he's going to renominate again. Jerome Powell has seen his days go from celebrating an elusive soft landing to now playing the tough balancing act of managing inflation with the potential economic impacts of a trade war while maintaining the Fed's independence in the face of political pressure. A perfect example of how the match is not over until the last ball is bowled. Some cricket reference. I mean, everybody thought soft landing was done. There were even, everybody thought this is it. Jerome Powell can now celebrate. He can pop open the champagne bottle. The soft landing is achieved. In what is his final year, it's going to be great. Nope. It went from what was going to be a very calm, relaxed final year to now doing a very, very tough balancing act of managing the economic chaos with along with the political challenges that actually has the power to threaten Fed's independence. Now, that's it. That's it from the Fed. Now, there is a reason why I keep saying that. I started off the show by saying Fed Chair Powell brings back memories of 2022, and that is because he actually called President Trump's tariffs plans, the inflation that is stemming out from these tariff plans, as transitory. Remember last time somebody said transitory. I'll fill on it in a little bit because I still need to take you through other economic data as well. So in addition to Fed, investors also had to deal with some key economic data. First, they had to digest a soft February retail sales data. More specifically, retail sales in the US rose by 0.2% in Feb, which was less than the expected 0.6% increase. Excuse me. When you exclude auto sales, the rise was 0.3%, and that was in line with expectations. So soft, it is soft, but nothing alarming, to be honest with you. I mean, January sales figures, was slightly alarming because they were revised downward, showing a 1.2% decline. Sales did increase at grocery stores and online retailers, indicating continued consumer interest in essential goods and digital shopping. However, falling sales at electronic and appliance retailers, department stores, and food services gave further confirmation that consumers were indeed cutting back on discretionary spending, something that I've been talking to you guys since the time I discussed Walmart's cautious guidance, right? About how consumers are cutting back on discretionary spending. Well, that's exactly what you get, what you're getting as per the latest retail sales data. There was a silver lining buried amongst all the retail sales data. Despite slower consumer spending, the parts of the retail sales report that feed into the GDP calculation actually rose by 1%. So part of the components of the retail sales data that actually go into the calculations of GDP did rise by 1%, suggesting the GDP growth slowdown may not be as bad as expected, or it might not be, it may slow down, GDP may slow down, but it might not contract in the first year. So remember, 2 consecutive quarters of GDP contraction, you have a recession. So sooner we get through each quarter without any contraction, the better it is. So based on the fact that some of the components of the retail sales data went into GDP calculations actually rose, and that they rose higher than the overall sales data, that suggests that the GDP could slow but may not contract. And then we had the February existing home sales data, which was actually very positive. I mean, it says a lot given the fact that the US housing market has been pretty terrible. So house prices have been up and nobody wants to move and nobody wants to buy, and mortgage rates 6-7%. So the fact that existing home sales rose by 4.2% in Feb, surpassing expectations, despite the ongoing affordability challenges, was definitely a positive. I mean, this increase was the first month-over-month increase in about 2 months. So last time was about in December is when we got, so not December, November is when we got the last month-over-month rise. So this was definitely a positive surprise because the housing market, the environment, the macro backdrop has not changed. Mortgage rates still are between 6 and 7%. Elevated home prices, all of which continue to deter many home buyers. However, based on this particular report and based on some of the other data within this report, there is an indication that some buyers are adjusting to this new normal, which is elevated mortgage rates and rising home prices and so on, and are making purchases either due to life events or improved inventory. Now, life events could be a divorce, or could be, could be, I don't know, bonus or whatever it is. So so because of these life events and improved home inventory, some people are like, you know what, it's okay, 6-7% we'll manage somehow, and so on and so forth. What's more, if mortgage rates do stabilize, then the upcoming spring season could see increased demand. Despite increases, the market remains challenging for many, many buyers. So overall, while there is a positive, I still have to leave you with a little bit caution, because don't read too much into the report, because very well in March report could be bad. So it's a bit of a tricky one, but at the same time, I would say any positive surprises you celebrate, not by going full guns blazing in the stock market, but at least you can have a sigh of relief knowing that not everything is crumbling around you in terms of the US markets or US economy and so on and so forth. I'm not talking about your personal lives. I'm talking about the overall economy, the markets and so on. So not everything is crumbling. Any positive surprises you can collect. For instance, retail sales, again, the factors that go into the GDP are positive, did rise by 1%. So which means even if GDP growth slows, it's unlikely that it has contracted, which means that recession timeline may have been extended, or we might be getting over it. Bottom line, even in a week where there was little tariff news, we still saw them, and them as in tariffs, play an indirect role by having a very strong impact on Fed's decision making when it came to interest rates. While officials still suggest that they still see up to 2 rate cuts for 2025, the entire dynamics of the Fed has dramatically been upended by Trump 2.0's tariff policies. At the same time, there are also serious questions being raised for the first time in a long time about the future of Fed's independence. While I continue to believe that the fears of the Fed losing its independence are overblown, one can simply never rule anything out. I would be an idiot to basically basically categorically say, guys, talk to me in a year, Fed will still have its independence. Talk to me in 5 years, Fed will still have its independence. No, really cannot, especially not in this current macro backdrop. You never know what changes in 24 hours. As I speak, a lot of things are currently changing for the markets. It's been whipsaw across in markets, whipsaw in terms of tariffs, whipsaw in terms of policy uncertainty, etc., etc., etc. So who knows, right? But as things stand, I think the fears are overblown. Can I absolutely guarantee you guys that Fed will not lose its independence? Absolutely not. That would make me an idiot. Now, for now though, and what I can tell you even more is that the Fed does appear to be dovish, as evidenced, like I said, by the comments made by Chair Powell at the press conference when he said that any inflation caused by President Trump's tariffs would only be transitory. Now, every time you hear the word transitory, your heart starts pumping, yeah? Remember, this is why I said it is back to memories of 2022 when Fed Chair Powell called it transitory. And basically what he did was, what you guys need to remind yourselves as investors is the last time that Chair Powell used transitory and inflation in the same sentence was back in 2022. And we all know how that ended. Yeah, we all know how that year ended. And if it weren't for ChatGPT, who knows how long that would have been, if it weren't for ChatGPT and the AI trade, who knows how long that would have gone on. So when he said transitory, my heart definitely started racing, because basically, I'm not, so basically last time he did that, things were not particularly good. So what I want you to do, markets as an investor, right? So what happened was, obviously markets shared the news last week, right? Rightfully so. There was some dovish comments from the Fed, fair enough. But investors, as an investor, as a US investor, what I want you to do is I need you to be very cautious going forward for 2 reasons. The first reason I've already given you, right? Basically, the last time Chair Powell said transitory and inflation, the same sentence back in 2022. We all know what happened in 2022. Stocks went completely haywire downward. Second, President Trump's so-called Liberation Day is fast approaching on April 2nd, when a new wave of reciprocal tariffs are expected to go into effect. Now, there was a lot of positive news on Friday as well as on Monday, because these reciprocal tariffs are expected to be more targeted than previously suggested. But will that turn out to be the case? We don't know. All I'm telling you is, you read a news, don't go all guns blazing in the market. Do a trade, that's fine, but we don't know. There is no absolute zero clarity on what's going to transpire on April 2nd. I don't think even President Trump knows what's going to happen on April 2nd. None of us know. So calm. Show some restraint, show some calmness when you are out and about in the equity markets. You are putting where you deciding to put your money in. Probably take it a little bit easy, and without too much of exuberance, because remember, every time you have the so-called irrational exuberance, just remember last time Powell used transitory and inflation in the same sentence back in 2022. And also just think about President Trump's zigzagging and whipsawing when it comes to tariff policies. So if that doesn't drive away any irrational exuberance, then it means that none of us, you and I included, have learned anything from the past. Boy, oh boy, do I hope that is really not the case. On that note, let me welcome you to the next segment, The Doctor Goes Home, where where I discuss the Indian markets, but I'm going to focus on one particular sector this week, right? Before that, let me just give you a quick update on the Indian markets. It was a week to cheer for Indian investors. The bulls made a comeback, including yesterday on Monday. This is being recorded on Tuesday. First day of the week has also been great. Today, the markets ended flat, but it's been an absolute amazing week for Indian investors to cheer as the bulls made a roaring comeback. But this week, I'm not going to talk about what transpired in the Indian markets. I will do that in the next episode, because I want to take a step back. I want to take a step back from the overall macro backdrop, and I want to focus on what has been a game-changing development in the Indian telecom sector. One that has the potential to drive technological adoption in the rural heartlands of India. Like I said, don't worry, I'll discuss the macro developments in the next episode, but I figured that you guys need to be aware about this telecom sector development as it ties to economic growth. The development I want to talk about, and I want to let you guys know, I'm sure many of you are aware of it, is that after months of fighting amongst themselves, India's top two telecom giants, Reliance Jio and Bharti Airtel, decided to roll out the red carpet for Elon Musk's Starlink, the SATCOM, or the satellite communication arm of the world's richest man's space company, SpaceX. So SpaceX satellite communications arm is Starlink, and after fighting amongst themselves, both Reliance Jio and Bharti Airtel, after poo-pooing on Starlink at first, now they've rolled out the red carpet. Let's start with the details before I really think what it is. Airtel plans to offer Starlink equipment through its retail outlets and provide Starlink services to business clients. This will help connect remote communities, schools, and healthcare centers. Both companies, both Airtel and Starlink, will explore ways to strengthen Airtel's network, while SpaceX will leverage Airtel's extensive ground infrastructure to enhance its services across the country. The partnership seeks to provide reliable and affordable broadband services across the nation, especially in underserved rural areas. 24 hours later, after the Airtel's partnership was announced, Reliance Jio metaphorically rolled out the red carpet again to Starlink as well. Jio will offer Starlink equipment through its retail outlets and support customer service installation and activation. The partnership will explore ways to complement SpaceX's direct offerings to both consumers and businesses. The partnership aims to extend high-speed internet connectivity to remote and underserved areas in India, complementing Jio's existing broadband services like Jio Air Fiber and Jio Fiber. This integration, hopefully, as per the company's expectations, will enhance the reliability and accessibility of high-speed broadband across the nation. Let me be very frank with you guys. The partnerships have come out of nowhere. Maybe you guys predicted. If you guys predicted, well done. I did not predict it. I've been following the telecom space for a while now, since Reliance Industries is one of my biggest positions. And at the same time, I am looking at Bharti Airtel for a potential investment for the future. I will let you know when I pull the trigger. So I have been following the telecom space for a while, and prior to these announcements, there's absolutely zero indication that these partnerships would even materialize. Forget about talks. It never looked like it would happen. In fact, on the contrary, it looked that the telecom giants would be going to war with the satcom players like Starlink. The partnership comes after a contentious debate between Indian telecom operators, primarily Jio and Airtel, and satellite companies that include Starlink and Amazon Kuiper for spectrum pricing. The Indian government sided with satellite companies, rejecting the telecom's demand for spectrum auctions. In November 2024, a heated debate occurred between Starlink, Amazon Kuiper, and India's top telecom operators during a Telecom Regulatory Authority of India (TRAI) meeting. The Indian telecom companies pushed for a level playing field, arguing for comparable spectrum pricing for satellite operators to avoid market distortions. As recent as last month, February 2025, Reliance Jio and Bharati Airtel had petitioned the Indian government to ensure a level playing field in satellite communication, emphasizing the need for similar pricing structures and regulatory levies for satellite services as for terrestrial services. However, once again, the government sided with Starlink, and the new telecom law allows satellite spectrum to be assigned administratively for a fee, but the final pricing details are still under consideration by TRAI. So the fact that the top two telecom players, up until last month they were fighting over, decided to team up after such a contentious period of debates and fights was an absolute shocker to investors. Positive shock, might I add, since it has the potential to significantly disrupt the Indian telecom space for the good. And the fact that this partnership substantially increases the odds of properly reaching the underserved rural areas is also an added bonus. Despite progress in mobile connectivity, a substantial digital divide persists between urban and rural areas, with about 48% of India's population, that's approximately 700 million people, remaining unconnected or underconnected. The gap has plateaued over the past 4 to 5 years, highlighting the need for innovative solutions. It just doesn't refuses to narrow. It just continues to widen. Traditional terrestrial methods face challenges such as installing fiber and towers in remote areas, leading to limited success despite significant government investments. Satellite communications offer a viable alternative to overcome these challenges. The integration of satellite technology with terrestrial networks can significantly improve connectivity. Starlink's partnership with Airtel and Jio are expected to provide high-speed internet that's approximately 20 to 100 plus megabits per second to underserved regions, complementing existing services like Airtel's arrangement with Eutelsat OneWeb. Remember, OneWeb is where Bharati chairman Mittal also has a stake in the company in OneWeb as well, along with the British government. The partnerships mark a significant shift towards something called co-opetition, where companies collaborate on sectoral growth while competing fiercely in the market. I like that word, co-opetition. I didn't invent it. I wish I had. Fantastic. You collaborate as well as compete. This approach could lead to a 30 to 50% in the broadband market in the coming years. And according to Citibank's latest report, the Indian satellite broadband market is projected to grow significantly, reaching $1.9 billion US by 2030, which translates to a CAGR, compound annual growth rate, of 36%. Starlink's global presence, with services in over 100 countries, positions it well to capitalize this growth. So when you combine all of these factors, one could see how crucial it was that the giants decided to partner with Starlink rather than cause fragmentation by just competing with it. They're still going to compete, but it's not just going to be competition. There's going to be some form of collaboration as well. This is a win-win for the companies as well as for the consumers. And this is why, to me, these deals are the biggest disruptors ever, since first, Jio unleashed the 4G war, and second, since India's 5G revolution took shape. Having said all the positives, investors do have to consider the negatives as well. I mean, I wouldn't call it negatives. I would call it a bit of a reality check. Like, I don't want to take you to cloud nine and then just drag you down immediately. So it's more of like, you got to be cautious as well here. Both deals don't guarantee a direct entry for Starlink. Okay, first things first. It still has to successfully apply for a SATCOM license, which currently is in the final stage. However, the road to success is not easy, as the government has outlined several security requirements and operational conditions that must be met, which includes establishing a local control center in India. So you can't just wire it via to the US networks. It's got to be a local distribution, local control center has to be developed if you need the license. So it's not done yet. Moreover, the Indian government is also considering imposing a spectrum usage charge (SUC) on SATCOM operators like Starlink, which could increase the cost of their services. SUC is typically about 3% of adjusted gross revenue generated in India, although in Starlink's case, it would be a lot higher. And in addition to the spectrum usage charge, Starlink will also have to pay an 8% license fee, which is applicable to all telecom companies operating in India. When you combine SUC, the spectrum usage charge, and when you combine the license fee, then all of which can increase operational expenses for Starlink and potentially raise the prices of its services. What's the point of serving underreserved rural areas when the people in the said underreserved rural areas can't afford it, right? Finally, we still don't know the pricing at all. We don't know the tenure. We don't know the taxation of the satellite spectrum, as the Telecom Regulatory Authority of India is still finalizing all these factors, and TRAI's recommendation would then need to be approved by the Department of Telecommunications. So deals might be a game changer. The game's not over yet. Similar to, just the promised landing, the game's simply not over yet. So again, celebrate, definitely celebrate. Look at Bharati Airtel as investment. I most certainly am, but don't just look at it for the sake of just the Starlink partnership. Game's not over yet. Bottom line, Starlink's deals with Reliance Jio and Airtel, should they materialize? Remember, I'm saying here, should they materialize? It's not like done and dusted, game over, no. Should they materialize, would be a win-win for companies as well as for consumers. More importantly, it would be a big, big win for Bharat, the rural heartlands of India, as Starlink can overcome the challenges facing the traditional telecom companies in these tough-to-reach rural areas. However, the completion of the deal is far from certain, given that there are a lot of challenges to overcome. However, one thing is becoming more and more clear with each of these deals that are being done, and with each passing day when it comes to telecom space. This is going to be a significant hit for the likes of Vodafone Idea and BSNL unless they can come up with deals of their own. As for investors in the telecom space, the out-of-the-blue partnerships that Starlink has made simply confirms what you guys probably already knew deep down. Indian telecom industry is a duopoly, and whether Mr. Aditya Birla of Vodafone Idea likes it or not, investors are better off putting their money with either Mr. Ambani or Mr. Mittal or both, as it has become very clear that the telecom playground belongs very much to them. On that note, I'm going to take you to the final segment, Dr. Dissects, where yet another Mag 7 stock is going to be discussed. Last week it was Microsoft. This week it's Google. And I don't mean Google. I mean Google's parent, Alphabet. I'm just getting the notes ready. I'm getting the notes ready for valuation time, getting the pages ready, right? But obviously, before that, I'm going to take you through a little bit of an earnings snapshot of Alphabet, like I always do with all the Dr. Dissects episode. The company, Alphabet, Google parent Alphabet, reported its Q4 numbers last month. After building a lot of momentum throughout the fiscal year, Alphabet ended the year on a whimper with a miss on the top line. More specifically, Q4 revenues came in at about $96.47 billion. While they were up 11.8% year over year, they missed analyst estimates by nearly $200 million. Diluted EPS of $2.15, however, came in strong, jumping 31% year over year and beating analyst estimates by 2 cents, albeit the year over year growth sharply decelerated in Q4 compared to Q3. 31% is still 31% is still good, but it was 37% in Q3. So the year over year EPS growth has certainly declined. Just keep an eye on it, is all I'll say. The company continued to post impressive operating margins, which once again came in at 32%, expanding by 500 basis points or 5%. Free cash flows for the quarter came in at $24.8 billion, billion with a B, which resulted in full year free cash flows of $72.8 billion, once again, billion with a B. Capital expenditures once again featured prominently in the outlook. Management announced that the company plans to invest approximately $75 billion in 2025, not million, billion with a B again. Q1 capex spend projected to be between 16 and $18 billion. The majority of the spend, unsurprisingly, was earmarked towards technical infrastructure, including servers and data centers, highlighting the strong demand that the company sees for both artificial intelligence and the cloud. Finally, specifically for the first quarter, revenues are expected to be negatively impacted by both foreign exchange as well as the leap year headwinds. With the leap year headwinds simply means that there will be one fewer day of revenue in Q1 of FY25 compared to Q1 of FY24, simply because there was February 29 in 2024. There is no Feb 29 in 2025. Simple as that. That's the snapshot. Now let me go to the takeaways. Ever since I initiated coverage of Alphabet, I've repeatedly mentioned about how impressive the performance of the company's cloud division has been. The fourth quarter was no different, as evidenced by a third consecutive quarter of more than $10 billion in revenues. Operating margins of the segment nearly doubled year over year, coming in at 17.5%, yet another impressive feat. However, despite posting these impressive numbers, what was concerning was that the revenue growth and the operating margins growth both slowed down compared to the previous quarter. For instance, in Q3, operating margins expanded by 5.49% sequentially. And when I say sequentially, from Q2 to Q3, quarter over quarter. In the fourth quarter, however, that expansion slowed down to 0.34%. So you had 5.49% in Q3 sequential growth. Q4 sequential growth was 0.34%. Revenues, same story. Q3 revenues saw a sequential increase, 9.7%. Okay, 9.7% quarter over quarter increase and a 35% jump on a year over year basis. Q4, however, saw revenue growth slow down to 5.3. So 9.7 in Q3, that has slowed down to 5.3. And obviously on a year over year basis, it's gone down from 35 to 30.1. The main reason for this growth deceleration, significant growth deceleration, might as well add, was unsurprisingly the capacity constraints, which has become a buzzword among the AI hyperscalers. You look at Amazon, you look at Microsoft, you look at Google, all of them keep saying that the growth deceleration has been because of capacity constraint. They just don't have capacity. There's demand, no capacity. There's demand, no capacity. Same guys, same things. It has been the go-to excuse. I call it the go-to excuse to justify that massive capex spend. So we don't have capacity, we keep spending. There's so much demand, we have no capacity, we keep spending. So I call it the go-to excuse. Anytime you want a 75, 80 billion spend on capex, basically it's a capacity constraint. That's it. Alphabet was no different. Like I said before, increased its capex spend for a whopping $75 billion, attributing the increase to capacity demand imbalance, capacity constraint. So capacity constraint, the go-to excuse for all these hyperscalers. Now, while having demand in excess of supply is always welcome news, I have no problems with that in general. The issue here is if every hyperscaler has a capacity issue, if every hyperscaler is making the same excuse, then it is likely that the return on investment on this capex spend is going to take a long time. With respect to Alphabet, the comments from CFO Anat Ashkenazi regarding the projected variability in cloud revenue growth rates in FY25 is concerning to me because it shows a lack of clarity over the timeline regarding when the sufficient capacity would be built. In fact, I'm waiting for when the excuse for capacity constraint, when it would be stopped. I mean, if I was listening to 3 earnings call back to back, and made a drinking game. Every time they say capacity constraint, take a shot. My goodness, I wouldn't get past one. And if I start with Alphabet, I won't even get to Microsoft and Amazon. That's all I'm saying. That's how I'm just stressing this demand. Not saying play the drinking game. Nope. I'm just saying that's how much every single hyperscaler is all going on about. We got to spend because we have no capacity. Anyway, coming back to Alphabet. In the previous quarter, management did offer some color on how the AI investments were paying off. More specifically, management announced that the AI investments in the cloud business led to a 30% deeper product adoption with existing customers. Investors received no such clarity in the coming quarter, except for anecdotal example. And when you combine these anecdotal examples without concrete evidence, when you combine this with the warning about the variability in cloud revenue growth, it causes more confusion than clarity, right? It causes more confusion over clarity when you compare Google Cloud's revenue growth in the coming years. And for a segment that continues to trail both the Amazon Web Services and Microsoft's Azure, this added lack of clarity can have a negative impact on investor sentiment. At a time when its search business is not only seeing a growth slowdown, but is also getting appended by the likes of ChatGPT and Perplexity AI, investors are looking to the future growth trajectory of Google Cloud as the next catalyst. In the age of artificial intelligence, the age of AI revolution, this is a very reasonable bet to make. Till date, among the three hyperscalers, Microsoft, Amazon, and Google, there is no clear winner in my opinion. And all three continue to spend massively. However, when you have a lot of catching up to do, the last thing you should do, Mr. Nath, Mr. Pichai, is to offer investors more questions than answers. Google's management unfortunately did that. I take my book, I take the pen, let's value. The company, Alphabet, continues to be the cheapest among the sensational six. So Google, Amazon, Meta, Microsoft, Apple, Nvidia. Currently, Google trades at so let me put Google here. Google trades at a forward PE of 17.75x. Okay, 17.75x is the forward PE according to LSEG data. It also continues to trade very cheaply relative to its own historical multiples of 21.6, which is the 5-year historical median forward price to earnings, and 22.5, which is the 10-year historical forward price to earnings. The median forward price to earnings multiple of the sensational 6 is about 26. Lower than my previous estimate of 31. This should not be surprising given the fact that Mag 7 or the sensational 6 stocks have taken an absolute pummeling since 2025 started. Okay, so it's been a very lackluster year. So the fact that their median multiple dropped from 31 to 26, yeah, shouldn't surprise you guys. And given the fact that Nvidia belongs to a different category, I'm dropping the company from Alphabet's peer list. You're left with Fab 5. And the Fab 5's median PE is 27, once again lower than my previous estimate of 31. Clearly, don't be surprised, 31.26, 31.27. The Mag 7, Sensational 6, Fab 5, Fab 4, whatever you want to call it, simply have not had the best of years, best 2025 yet. The last time I talked about Alphabet, I had assumed a forward price to earnings of 22.4 for my calculations, which was its historical 5-year historical median forward PE at the time. I am maintaining this multiple, so I'm not going to do 17.75. I'm going to do 24, okay? And I'm going to give you the reason why. I'm going to maintain this multiple for my calculations, despite being significantly lower than the median PE multiple of the peers. I believe that 22.4 is a reasonable assumption compared to 27, since the competitive landscape continues to remain challenging and given that FY25 appears to be a year of investment for the company, as evidenced by the $75 billion in projected CapEx spending. Moreover, management announced that there would be significant variability in the cloud revenue growth, and some of the tailwinds that the company experienced in FY24 are not going to be there. For example, election-related advertising. So when you consider all these factors, this 22.4 makes complete sense rather than taking a higher multiple at 27. The consensus EPS estimate for FY25, according to LSEG data, stands at $8.94. Significantly lower than my estimate of $11.11. Now, the difference in these estimates can be attributed to the fact that I assumed an EPS growth of 35% for FY25, whereas according to consensus estimates, the projected EPS growth rate in FY25 stands to be 11.6. So there's a significant decline. I think I was a significant difference. I was a bit too over optimistic. The markets got this right in terms of assumptions, especially when you look at the management commentary. Alphabet has a track record of consistently beating analyst estimates of EPS, with the company beating EPS estimates in 4 of the last 5 years. FY22 being the only outlier. I've already talked about 2022 with you guys in the earlier first segment. You already know why it could be the only outlier. The margin of the beat though, the margin of the EPS beat though, has been decelerating in the last couple of years. On average, the margin of the beat has been 2.9%. Due to the margin of the beat being well below my estimates and being the lowest margin beat in the last 5 years, this average is significantly lower than my previous estimate of 4%. So I've adjusted my expectations appropriately. And now I project Alphabet to beat analyst EPS estimates by 2.9%, which would result in FY25 EPS of $9.20. FY25 EPS of $9.20. This translates to a year-over-year growth of 14.4%, lower than the company's long-term average growth of 19.8%. Again, very reasonable estimate given that FY25 is a year of investment and the cloud variability, same reasons. When you take 22.4, okay, when you take 22.4 and then you do 9.20, you multiply it with 9.20, you get a price target of $206. So 22.4 multiplied by 9.2, it's $206. Although significantly lower than my price target, previous price target of 248, little optimism on my end. My bad. I've got to acknowledge when your optimism is wrong, you've got to adjust things appropriately. So 206 is definitely a drop off from 248. However, it still represents an upside of about 26% from current levels. 26% from current levels. 206 is my price target, 26% from current levels. Given the significant upside, while I am downgrading my stock rating on the stock, I'm only downgrading it from strong buy to buy. So earlier it used to be strong buy, and now it's simply a buy. So price target 206. So price target $206, 26% upside. The rating on the stock is a buy. When there is a bull case, when there is a buy rating, I always talk about the risk factors. We've got to discuss the risk factors. In addition to macroeconomic shocks such as FX headwinds, the other risk factor to my bull case on Alphabet would be the timeline of the return of investment that the company has pledged towards CapEx. $75 billion number was definitely a surprise, but it is not uncharacteristic given that all of Google's peers are also spending. But therein lies the problem, as I've mentioned earlier. With an increasingly competitive landscape and with Google Cloud continuing to trail behind Azure and AWS, investors have to factor in the scenario where the return on investment may take longer for Google compared to its peers. This would subsequently impact my EPS growth estimates should this particular risk factor transpire. Bottom line, Alphabet ended the year with a mixed quarter. Revenues missing, EPS exceeding estimates. Simple as that. Despite the cloud segment registering a very strong performance, both the year-over-year growth in both revenues and operating margins of the segment declined. Furthermore, during the earnings call, management, while announcing a massive capex spend of $75 billion for FY25, warned that there would be a continued variability in cloud revenue growth as the company attempts to bring more capacity alone. Capacity online, bring more capacity online. Capacity constraint, capacity online. Same story, same excuse. Sentiment analysis and management remarks show negativity creeping into Google's management compared to the rest of its peers. It should be concerning to Google's investors, especially since Google Cloud continues to lag behind its peers and given the massive capex spend that the management just announced last month. The only silver lining is that the stock has been beaten up so much since the earnings report and since in the last few weeks that it continues to remain attractive even at current levels. As such, I have still maintained a buy rating on the stock, although it is with a significantly reduced price target. Despite being attractive at current levels, given the declining sentiment of Google management with each passing quarter relative to its peers, and given the sort of trailing of Google Cloud with respect to AWS and Azure, all I will say, my parting word to you, my parting, not advice, my parting comment to you would be, caution is certainly warranted. That's all the time I have for you this week. If you have a specific Indian or US stock suggestion for the doctor to diagnose and dissect, do tweet me at Uttamvinay, UTHMVINAY, or email me on thestockdoctorpodcast@gmail.com. Thank you once again for listening. I will most certainly see you next week. Until then, stay safe and make some money.